The key is, how can we get the liquidity to get into the game here? And that's what most people don't know, because once you have liquidity, opportunities will present themselves. You're going to be listening to this podcast and you'll have another deal coming due, right? You might learn about hard money lending for the first time.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today we're joined by Alan Franks, a certified financial planner and author of Empowered Money. He's gained national recognition for his practical approach to navigating complex economic challenges. What makes Alan unique is his ability to transform high-level financial concepts into actionable strategies. And he recently made headlines by revealing how the American dream now costs $4.4 million. As a regular financial expert on national television, Alan brings a fresh perspective on building wealth in today's challenging economic landscape. Alan, thank you for being here. How are you, sir?
Thank you guys for having me. Feeling great this morning. Ready to have some fun with you guys.
That's great. We're excited to have you on board. I was saying right before we started recording that this might be one of the rare times that I actually ask some of the questions that are on your bio, because I think we have a lot of our conversations kind of tend to go fairly high level because I nerd out and ask selfish questions for myself. But the reality is, I think that with what I understand about your approach to things and a lot of the interviews that you've done on national media is that you're really breaking things down to the common man. Like, what are the everyday challenges that everyday Americans are facing in the current economic headwinds? So I really am excited to dig into that. Before we do, why don't you tell us a little bit more about yourself, how you chose this lane, and what you're doing in this space?
Yeah. So I chose this lane out of frankly desperation. So I studied economics at Mercer University and graduated in 2010 in the depths of the economic recession right there. And so when I went to go look at job prospects, I really had two opportunities. Number one, I could go teach elementary school in the Mississippi Delta for a program called Teach for America that was really just a feeder program to really good MBA's programs. Or I could go take a commission-only sales job in financial planning. And so that's the way I went. And I did that for about 5 years. I learned a ton. I learned what I didn't want to be when I grew up, which is a commission-only salesperson. And so my next move was to really build a comprehensive financial plan. I will say one caveat here is I think it actually started a long time before that. My dad was always there. It brought me to meetings, brought me to meet with his life insurance guy, his investment guy, and brought me to a time he bought, this shows the times here. There was a time where he bought 6 rental homes at one closing, right? These stacks of paper, the trees that we killed that day were unbelievable. And he did it with no money down, right? So that's obviously a little bit different than the environment that we are today. But for fun, we used to play this game called Cash Flow. The Robert Kiyosaki, Rich Dad, Poor Dad.
I just bought that for my 5-year-old, like this week. Yeah.
It's the best game. It's so fun. So me and my 2 brothers sit down with our dad. And anybody who's never played this game, if you want to teach your kids about financial planning, that's the best way to do it because it's interactive here. But basically, there's this circle called the rat race here. And the only way to get out of the circle is to have your passive income be higher than your monthly expenses. And once you get there, you get on the fast track, which is on the outside here. So I think we're going to talk a little bit about passive income today. So that really kind of framed the way that I look at financial planning and the way that I handle even my own finances.
I knew you were an apostle of the Purple Bible, just with the way you talked about your dad being in it, buying no money down. You saw it at an early age. You just that classic rich dad, poor dad, got to see it firsthand, and that early impression in your life turned into something that changes your thought process, right? And
Totally. And hey,
same thing. I read Rich Dad, Poor Dad in college, and then that started a long and crazy rabbit trail from there. But yeah, I literally my 5-year-old has just gotten big into board games recently, and so we just ordered Cash Flow, and I've got it sitting on the mantle at the house. It's so
you're going to have a blast with it.
I'm excited.
So one of the criticisms of the Purple Bible is that it's a great mindset book. It shifts your mindset, but it's not filled with a whole lot of actionable content. So, we're talking about this, that's sort of one of the things that how can the common man take that book and turn that into some actionable things, also given the state of sort of where the economy is now?
I'm certain that you guys have talked about this ad nauseum. There's no such thing as passive income, right? What a bogus lie. And I was actually listening to one of y'all's previous podcasts. So I think one of us did it the same way. I have 6 rental homes. I've got a couple duplexes. I've got a few Airbnbs, a few midterm executive rentals, a few long-term rentals. And I love how I did it. I wouldn't say I did it the wrong way. That being said, one thing that's really happened since then, or a couple things have happened. Number one, I've got kids now, right? And all of a sudden, those calls from the tenants are just getting more annoying, right? And not only that, um, our incomes went up. So when we started doing rental homes, like that extra income was really, really nice. And now all of a sudden, the time I'm spending on my income is actually taking away from my day job, which is making a lot more money than that, right? So you got to look at that. And then the third thing that's happened here is the cost of home ownership is so freaking expensive right now. And I call this silent inflation. So talk about the economic headwinds here. I call this silent inflation. You know that your grocery bills are going up. We feel that, right? What we don't necessarily feel, because there's really not a darn thing we can do about it, is that our home insurance has gone up 50% over the last 5 years. Our taxes have gone up tremendously, right? And then let's not even talk about replacing an HVAC system. Oh my gosh, how does someone making 100 grand, how do they afford a new HVAC system when it goes out, right? And the truth is that they have to finance it, right? So the cost to replace a home, the cost of the landscaper, the cost of your utilities, and then the stuff you don't really see because it's coming out of the mortgage have all gone up. Well, what's also happened? The supply for rental homes has just taken off here. And there's 2 reasons. Number one, if you thought you were going to get into the Airbnb market, 3 years ago, we launched about 10 Airbnbs in our clientele, making money hands over fist. Well, what happens? Supply goes up, right? Supply goes up, demand stays the same. And then all of a sudden they open up borders and then demand drops right there, right? Well, this wealthy person that didn't really want to rent their house for $5,000 a month did want to rent it for 20 grand a month. And now, even though it's gone back to 5 grand a month, he already has a listing. He already has the photographs. He already has a manager. Well, I'll just go ahead and continue to make 5 grand a month to at least pay some of these bills. So we have this huge influx of supply here, and the demand went down. And now all of a sudden, these second homes at the beach or the mountains are barely surviving, if even that. Take that to a long-term rental. Y'all had somebody on here recently talking about hard money lending and flipping homes, right? Well, guess what? These homes are a little bit underwater right now that we're flipping. So what did they do? They went and they listed those for rent, hoping that when interest rates go down, all of a sudden pricing goes up. So even my homes that I got at really good interest rates at really good money, even those are struggling a little bit right now. And the truth is, trying to go out there and buy a home right now that you're going to rent, I mean, we're looking at 3 to 5 years before you're turning a profit. And that's not viable for most people. So, and I'm not here to toot y'all's horn. I am not. That is not why I came on this. But I am a believer now in, instead of being a business owner, okay, instead of being a business owner where you go out, you buy the home, you do all this, be an investor. Be an investor, right? Let somebody like you guys go do what you do best, and you go and you build your career and build your income and spend time with your family. Do those 2 things, but let syndicates there and experts like you two go out there and do all the hard work and all the research and then just collect the checks.
Thank you, Alan. Checks in the mail. Well, appreciate you. I guess we can cut this one short. We thought we were going to have to milk it for 30 more minutes to get that confession out of you. But listen, you're preaching to the choir here. I still own 14 Airbnbs on a small island community where Neil and I live. When I bought the first ones in 2018, there was 1,128 active listings on that island. We started last summer with 2,600. We ended the summer with 3,600. And a lot of people were using bad data from the previous 2 years. That was the post-COVID era short-term rental. The one thing about Airbnb that you cannot control is how much supply is in the market. right? And all of a sudden you find yourself, things were ramping up, and all of a sudden we were a part of the supply in a market that had unbelievable demand. Well, then when the supply more than triples and the demand falls by at least 50%, obviously you got problems there. And people bought properties with the expectations of rental income that's not materializing, right? And that's just one asset class, right? But across the board, what you bring up this is one of the frustrating things. It's always easy to identify what's not working right now. Airbnb is not working right now. Single family rentals is a very slow way to get ahead. It's really hard to add enough value to any property that you can either refinance out of it without leaving a lot of money in if you're trying to do the BRRRR strategy, because the interest rates are so high that besides just cannibalizing your cash flow, you're going to have to leave a big chunk of equity in that property for it to cash flow. And it's the same thing with flips. In order to get a property where you can force enough appreciation to sell it, the hard money carrying costs are going to eat up part of that. But the other really tough part is that the market has appreciated so fast because there's so much money coming into the system. It's really hard to buy correctly up front. Like, you don't make your money when you sell a house that you flip or when you renovated it. You made it for when you bought it at the right price. And that's becoming more and more challenging. And so one of the things that we're seeing is one of the things Neil and I were talking about yesterday and this morning is we're starting to see a prevalence among operators like us of things like a debt fund or an income fund, where like traditionally we raise money for the projects that we do, and people are going to get a 19 to 22% IRR by investing with us, and we take the ride together. They're equity owners in the property, and eventually we have a nice payday at the end of it, and everybody gets paid, and then we keep it in our case, and we all hold it together and continue to cash flow. That was a model that worked really well for a long, long time. So many people have been burned in the last couple years that you now have people calling for a debt fund or an income fund, meaning like, look, we don't want any equity. We'll take 10% or 12%, just pay it out monthly or pay it out quarterly. Just be nice and consistent and give me 90-day liquidity where I can get my money back out. Instead of making the 19 to 22% with higher risk, because so many people got burned, people would rather make a little bit less and it be stable and secure. And even at that lower return, it makes more sense for people to go be a passive investor than to go out and try to be an active investor on their own. And we tell people like, look, if you're flipping houses right now and you're doing well and you're making 30%, do not invest with us. Keep going, because if you can operate right now, you're a different breed. But there's most people out there are not able to pull that out. So it's easy to see what's not working. And I agree with you. We're starting to see a lot more money moving into syndication, specifically partnering with people that are doing this professionally and have been doing it professionally. We can't even find a self-storage facility with enough value that it makes sense for us to buy it and increase the rents or fix it up. We have to buy a nasty old Kmart building that's been empty for 12 years and convert it into a storage for it to make sense for us. And this is all we do. So besides that, we've seen a ton of new ground up development has screeched to a halt, which for us, we think is great, because we think in the next 2-3 years, there's going to be a lot of appetite for acquisition there, and the supply is going to be down. The demand is going to be good. So we're playing this game 2-3 years in advance. So totally agree with everything you just said. Knowing that and where we are, talk to me about a couple things. What are the opportunities that are out there right now? And more importantly, like if we're working backwards from a goal, and like what is the goal that makes a meaningful difference in the average American's life in terms of the amount of time I get to spend with my family or with my spouse, or how much time I have to spend trading that time for money at a job, paying for somebody else's days off, hoping to maybe get the company match and one day save my way to retirement. Our parents and grandparents could do that. If I save my whole life and I can put $1.53 million in the bank, you're telling me that's not enough now? So tell me, like, what's the goal that we need to be working backwards from? And what can the average person do to, like, the goalposts have moved, right? That we didn't move, the goalposts have moved. First thing, we need to acknowledge where they are, and then tell us about the opportunities to work backwards from there to make it a reality.
Totally. So, one of the books I'm reading right now, and I swear this is one of the best, besides obviously besides my book, Empowered Money, one of the best books I've ever read, is called The Psychology of Money. And he really dives into when you are buying something, whether it's a new car, a new suit, right? What you're also or let me rephrase this. When you don't buy something, when you don't buy that new car, what you're really buying is freedom. When you don't buy that new suit, what you're really buying is freedom. When you don't go buy that new house, let me tell you something. As somebody who waited a little long to get their primary house, I had a lot of rentals, but they were kind of smaller. I needed a place to raise my family. Waited a little bit long to get my primary house. Let me tell you, the amount of freedom that I have, is about $5,200 a month less right now. Or if I were to look at what I would have been able to gotten before interest rates went up, it's about a $3,000 swing, right? So when you don't go buy that new thing, what you're really buying is freedom. And really, what we mean by freedom is we're buying time, our time back. That's what we're doing. We're working 30 years to buy our time back so that we can one day not do what the man wants us to do right there, right? And so when we're looking at what are our goals, what should our goals be, I think the funnest part about financial planning is the intersection of your life goals and your money. That's why I do what I do. I don't do what I do to go get the best rate of return out there, to build the most amount of money, all that stuff. Of course, those are parts of it. I do what I do because when we use money properly, when we do financial planning properly, we can reverse engineer a plan to help you live your ideal life. And we could probably do it a lot quicker than what you think. It's just we don't know how to do it, right? So I'm going to quote another book. I love this book. This best book I read last year. Who, Not How, right? Who, Not How. Well, you guys
so far,
yeah.
This is Morgan Housel with Psychology of Money. And these are the two books that we quote a lot. We were laughing because we talked about Psychology of Money on the last episode.
Yeah.
And Dan Sullivan's Who Not How. We're 85 episodes in. There may be 3 episodes where I haven't mentioned that book. Yeah. It's a solid one. Keep going.
Unbelievable, right? So here's the deal. To all your listeners, you don't need to know how to reverse engineer a financial plan to get you to retire at age 55. You just need to know who can help you get there, right? Now, a disclaimer here. The who, not how method can get a little expensive, right? All of a sudden we're outsourcing a lot of stuff, right? So at some point you do need to know a little bit on the how side, but that's what I love about financial planning is that intersection between what you want your life to look like and what your money is, right? So when we're talking about goals, and this is really what the book's about. What the book's about is if we're gonna set a goal, we need to have a very clear idea of where we are financially and where we want to be. And it's just goal setting 101, right? So when I'm taking on a new client, the first thing I'm doing, where are you right now? Where do you want to be, right? And then what are you currently doing to get there? Because what I'm looking for as I'm taking on a client, can I get you there a little bit quicker, a little bit more cost efficiently, a little bit more tax advantagely, right? I'm going to guess a lot of people listening here, their biggest expense is not their house. Their biggest expense is not food. Their biggest expense is taxes, right? So if we can help them mitigate their largest expense there, we can get them to where they want to go a lot quicker. Now, going back to how do we get started, right? This is the biggest thing, is that most people do not know how they can access the cash needed to go and invest with you guys. They don't know how to do that, right? So what I do is I take a step back and I share with them, how can we be what I call liquid, but not lazy? All right, liquid, but not lazy. Everybody knows we need 3 to 6 months in an emergency fund. I'm not going to debate that. That's probably, there's some more to that, but that's probably pretty close here. But the key is, how can we get the liquidity to get into the game here? And that's what most people don't know, because once you have liquidity, opportunities will present themselves. You're going to be listening to this podcast and you'll have another deal coming due, right? You might learn about hard money lending for the first time, right? There might be an apartment building that you get to go in and be part of the ownership group. Well, how do we find $100,000, right? And so the first thing, if we were going to give any really specific things to do in this meeting, I am a massive fan of something called a line of credit. I have a line of credit on every single asset that I own here, right? And let's take the most common one, a home equity line of credit here. All right. A home equity line of credit, to be clear, the equity in your house it's doing something that we call a Blutarski. If y'all remember Animal House, Blutarski had a 0.00 GPA, right? Well, guess what? That's the rate of return of the equity in your home right now. Right. Now, to be clear, your home is going to increase in time, typically, not like it has the last 5 years, typically closer to 3% here, I think, going forward, right? But the equity in your home is sitting there and it's worse than being in a cash account, right? So the first thing that we're going to do is we're going to go get, typically they max out, let's go say $250,000, depending calculation. You take your home value, multiply it by 0.8, and you subtract whatever your mortgage is, and that's how much you can get. Well, now all of a sudden, let's say we have $125,000 of liquidity. I guarantee you two things. Number one, you're now safer. You have more liquidity, right? But the opportunity is going to find you, and that is where we can find the money. Another line of credit that most people overlook, and I think this really separates our firm from other firms here. Every single taxable account, can't do this with your IRAs, your 401ks, but taxable investment account, every single one of them, we are getting a line of credit against. Okay. And it does two things. These lines of credit do two things. Number one, they're a security blanket. All right. So great story. Had a client with a good amount of money, wanted to redo his basement. He was retired now. And so it was 2022. And he needed $100,000. So he asked me to sell stock for $100,000. Well, 2022 was that dip. Remember, markets were down about 22%. Right? His portfolio was down about 14. I said, hey, instead of selling your stocks, let's go get a line of credit and let's borrow. And at that point, interest rates were 7. So let's say that he paid $7,000. Right? So instead of realizing his losses and selling $14,000 of stock, okay, he borrowed and he paid 7. We just made him $7,000 because what happened? Stocks recovered. But that's not the full story, right? We could have sold right there, paid off the loan, but we didn't. We kept it invested because what happened then? It went up another 14%, right? So we paid $7,000 to make another $14,000. So in general, over a 2-year period, we made this client $14,000. So a line of credit is a huge security blanket against down markets. But what I like most of all is it's an opportunity fund. It's not just an emergency fund. It's an opportunity fund. And so here's my big thing. If we take nothing away from this podcast, okay, I want you to know, most people make money and they spend money. A select few make enough money to save some. And then even fewer people make enough money and they have enough saved that they can now go invest. Okay, particularly in a taxable account once 401ks are funded and things like this. Now, here's the deal. Most people invest $1 and get $1 working for them. That's not how wealthy people invest money. Wealthy people take $1, invest it, and they get $1.50 working for them, right? Because what I want my clients to do, right, is to go invest in the market. Guys, the stock market is a phenomenal vehicle. It's basically just buying into companies here. As those companies hire smart people who work hard, their companies will grow, your portfolio will grow. That being said, is it going to give you a 20% rate of return like you guys? No, not over time, maybe recently, but in general, let's say it's going to average somewhere, 8%, give or take a percentage point over time here, right? So we have that working for us. And by the rule of 72, it's going to double every 10 years, right? Well, that's great. That's where my dollar is working. I'm going to go take a line of credit and I'm going to go invest with you guys. And y'all are going to do two things. Y'all are going to safely give me an income stream that's going to allow me to pay back the loan on the line of credit, right? And then you're also going to give me arbitrage. I borrowed against the line of credit at 7. You guys gave me 20. Yes, I'm going to go make 8, 9, 10% of the market over here. And that's going to be mostly growth right there, which is super important. Then you guys are going to give me an extra 10, 12, 13% income on top of that. Come on. This is beautiful. That's how we accelerate the wealth growing process.
So what about in that scenario, say somebody takes out an equity line on a stock portfolio, interest rate is 7%, and the stock goes down? Can they call the note on that?
Hey, so we got to be, the reason I said 50 cents on the dollar is we can actually get you 65 cents on the dollar. I really don't want us to go up to that limit because there is
Because
the
of the
risk
leverage.
there.
Okay.
Theoretically, they could also do it on a home. I don't know if that actually happened in the '08 financial crisis. We don't have a lot of data on home values actually going down. They most of the time go up. Stock market, though, there's a lot more data there. So we do have to understand the risk there. And that is one of the risks that, hey, if we borrow 50% and then all of a sudden markets go down here by 40%, we have another '08 financial crisis, we might have to sell some stocks there at a loss, and that is a risk. So we do have to manage how much are we actually going to borrow against that.
Got it.
Yeah. What we're really talking about here is return on equity. And, as people who invest in single family rentals or big commercial buildings, like at some point, your equity in the property gets to a point where when you look at your return, it's not a great return. Like if I have $100,000 in equity in a rental property that's maybe worth, I don't know, 200,000, I still owe 100,000 on it, and it's making me a net of $500 a month times 12 is about $6,000 a year. My return on equity is about 6%. Like you start to figure out, and essentially what you're doing is you're leveraging, all right, I've got equity in this asset that I can tap into. And yeah, I'm going to maybe cannibalize the cash flow, which is kind of negligible as it is. But now I'm going to put it to work at 13%, 18%, 22%, rather than sitting in that asset only earning 6%.
Yeah.
I think a great example was, I've compare real estate to their bond portfolio. I actually would compare it to a utility stock. You're going to get some slight growth and a decent little dividend right there, right? But depending on what time of life you're in, I mean, I'm 37. I would never own a utility stock right now. I don't necessarily need the income right now. I need to be a little bit more growth focused at this time in life. If I've got somebody who's retiring, then all of a sudden, that utility stock really works. So you're right there in that we've got, right, the biggest cost, guys, the biggest cost with whatever we do is not the fee that the fund manager is going to make or the person putting the deal together. That's not it. The biggest cost of anything we do is something called opportunity cost. What else can we do with that money there? So the one thing I do like about using the line of credit is we eliminate a lot of the opportunity costs because we're able to have the stock market working for us. So even if a deal goes sideways, right? Because if you do this enough, guys, you're going to have 8 winners and 1 loser. Let's just, 9 winners, 1 loser. Let's say we have a loser every 10% of the time. All right. So if we have 250 grand to deploy, we go deploy it in this real estate project. Let's say something goes wrong, right? They're smart people. They work hard. Let's say they were affected by hurricanes, right? Or wildfires, right? And it doesn't go well, right? Well, at least we didn't lose the opportunity cost of what that money could have done in the market. Because once again, the markets, they are a little slow. They're a little boring. They're not as exciting as some of the deals that we would talk about. That being said, in general, they will double every 10 years, right? So even if you had $250,000 that you lost in a deal, as long as we have that money in the market working for us. So it seems we'll be able to make up for that loss. So it seems a little bit more aggressive on the outside to take a loan against your assets. But truth be told here, it's actually a safer way to do it.
So there's something else to this that comes to mind is, and you've actually talked about this on some of your national platforms recently, is I want to talk about inflation a little bit. Because one of the things that we need to keep in mind is like a lot of times people are using after-tax dollars and your goal is to sock that money away and save that money fast enough when it can make a meaningful difference in your life later on. But the value of those dollars are sometimes being sucked out of the drain hole faster than you can put more in, right? So, and that's probably recency bias because we recently saw an inflation rate of 9% for a period of time. And people talk about, oh, well, inflation's down. That's actually not true. Like inflation growth is down, but prices aren't down. They're not growing as fast, but not only are they not back to where they were, they're never going back to where they were. The cost of goods and services go up with inflation. When inflation goes down, they don't come down. They stay there traditionally because people know how much you're willing to spend on it, right? So talk to me about, you mentioned that within your client base, you've had increasing interest in alternative investments versus traditional saving vehicles, which are becoming less attractive. I'm interested to see how that's played out. And then also in terms of inflation, it's to the point it got so bad that it's changing people's investment strategies. So based upon what we're seeing, like 2020, 2021, and years previously versus the last few years, like how is that changing? And is that tied to the argument that you make about the average American needing 4.4 million to get ahead? Like tie all this together and land the plane for us on that.
Totally. The most demoralizing part of that study of $4.4 million is that they do this study every single year. And last year, the number was 3.4 million. How demoralizing is that, right? Inflation is such a beast. And I don't want to scare anybody on this call, but there's typically two waves of inflation, not one. Right. If we look back at what we would call the Jimmy Carter era, the late 70s, early 80s, there was two bouts of inflation. The first bout, and then we had it suffocated. What happens is this happens. We all of a sudden are like, hey, inflation is back to 2 to 3, right? We can now all of a sudden start to be aggressive again. And what happens is that we had it on the curb, but we didn't curb stop it. So now all of a sudden it's going to come back here, right? And so the reason that if you're yelling at Jerome Powell for not lowering the interest rates, I just want to let you know the reason is because of the late 70s, early 80s, because the first bout of inflation, people can sustain. It's the second bout where the cash reserves are low, and this could be a person or a business. The second bout is what puts people out of business, right? For instance, let's say that you're a mortgage lender right now. You have struggled the last couple of years, right? But you're just holding on for dear life. Well, if all of a sudden interest rates skyrocket again, you're going to go look for another job, right? Or let's say that you're in commercial real estate. You're really having trouble finding selling property right now because of interest rates. And so you can just keep on going and going and going here is that people have dwindled down their cash. There's a great graph where the COVID crisis is the only crisis in American history where people's savings accounts went up. Every other crisis, they kind of stay flat or go down. This one, they went up. Well, guess what? They're back to normal, right? People have burned through that excess cash. And I tell you what's so sad is I'm seeing it on a daily basis. When we bring on a client, we go through, we have a software, we go through every single expense of the last year, every single line item we go through, right? And the biggest thing that we are finding is that they are eating the same exact food that they were 3 years ago, but their food budget went from 1,500 to $3,000. Let's go 2 to $3,000, and it's up to 4 to $5,000. Same exact stuff that they were eating, right? And one of the things that happened here is I'm not just going to blame inflation here. The truth is we do have a spending problem. It's us, right? And we've got to learn how to adapt better because we went through COVID and all of a sudden, a lot of us felt that we were rich. I can only imagine how you felt with 15 Airbnbs on a beach, buddy. You are financially invincible, right? Well, what happens is that when we start feeling that we're rich, we start to develop some bad habits. Then reality comes back. Oh, we're not rich, but guess what we still have? We still have these bad habits here, right? And so when I'm working with somebody on their budget, I am telling them that we've got to wake up here because we have to adapt on this. So when we're looking at inflation here, it's affecting everything. Yes, it's affecting what we're investing in, but more importantly, it's affecting the money we have left over to invest. And it's actually really hurting kind of my stage of life the most. I spend $8,000 of after-tax money right now on my house and my nanny, right? That is an astronomical amount of money, right? If a financial planner were to call me and ask me to save $2,000 a month with him right now, I would laugh him off the phone, right? And so what we're seeing is inflation hurts the people who are spending the most money. And typically those are younger families with larger food bills, things like that. And so, yes, it's affecting the opportunities that are out there. It's also affecting how much money is left over. And let me say this one thing, because it's so important. Tariffs are a big deal right now. Massive deal. What I'm about to say is not political. Tariffs are not good for inflation. That is not political, right? That is economics 101, right? Now, are these tariffs going to stick? I do not know. Are they a negotiation tactic? We will find out, right? But I want you to, picture if your town, your island, put a toll there and it charged everybody $10 to come in on that island, right? Well, initially, it's going to raise some revenue for the island, no doubt. And also, it's probably going to boost local business because let's say there's an electrician on the island, but you were getting the other electrician from another island to come in because maybe he was a little bit better, maybe a little prices, right? So, for that electrician on the island, all of a sudden they have less competition, right? So they're going to have more demand. So what are they going to do? They're going to have to bump prices up because it's going to be hard to keep up with that demand, right? So slowly but surely, all of a sudden, these prices go up. Then eventually, they'll go up so much that we still need to bring in that electrician that pays $10 to get on the island. But guess what? He's going to pass that $10 on to you, right? So in general, I'm a free market economist. Anything that lessens competition is going to be bad for the end user in time here. But what we're about to see here is that the other island that you also like to go to because there's good restaurants on there, they're going to put a toll booth on that island too. And now you're going to have to pay $10 to go to that restaurant over there. So I'm not, we're going to stay away from politics today, but when we look at inflation, I will say this, I am concerned about that second wave right now. I don't think we're done. As you mentioned, prices will never go back down. We do not want that. That's worse than inflation. Prices going down is worse than inflation. And I think it's important to know that, hey, not everything's the same. Like gas right now is much cheaper than it was when I went to go buy a car, my first car, right? So not everything inflates the same way. But when we're talking about inflation in general here, prices will continue to go up. We just really hope that they're going up 2 to 3%. That's a healthy way and not going down and not going up by 7, 8, 9, 10.
Well, let's land the plane on this because that was going to be my next question was about tariffs. So, but let's wrap this up. Final question. What do we do with that information?
Yeah.
Where's
over the next smart money going?
Over the next 2 years, we've just barely maybe tamed the inflation tiger, at least the rate of inflation. Obviously, prices have not gone down. And then now we're faced with, a trade war that may all of a sudden restart that second wave of inflation. So what do we do? What do I do as an investor with that information?
Totally. So a couple things. Number one, we have to realize that the rules of the game have changed. When I wrote my book, Empowered Money, it was under the old world order, right? It was pre-COVID, right? And we talk a lot in there about, how do we build rental homes, things like that. We just have to know that these are new rules of this game. And what's a good deal then may not be a good deal right now. And we can't keep on hitting our head up against the wall there, right? Number two is we got to realize that if you're listening to this podcast, you probably won the last game and you're probably going to win this game too. It's just going to take a little bit of time and you have to be willing to adjust here, right? So what exactly does that mean? Well, I will say this. The good thing about real estate and really about stocks too, is that they are hedges on inflation. Here's what's clear to me. If you did not have money pre-COVID, you sure as heck don't have money now. If you had money pre-COVID, you have a ton of money now, right? So what we are actually seeing is that businesses that are there to scale and are there for the masses are having a really hard time. Because if you're running a volume-based business here, it takes a lot of staff, a lot of things can go wrong, margins are tighter, right? But when you look at businesses that are very specific and frankly catering to that wealthier population there, those businesses right now are thriving. In Atlanta right now, we're seeing a lot of these dinner clubs open back up where you have to have memberships to get into the place to dine. Yeah, that we couldn't have fathomed that 5 years ago, but those kind of places, exclusivity, those higher end places are doing really well. And other places that are tending to the masses are really struggling. But I want to give one example here of how we have really adapted to right now. Number one is I'm going to talk a little bit about investments and just allocation, right? In a typical portfolio, we are trying to follow what we call the efficient frontier. It's based off something called modern portfolio theory. That's from like the 50s or 60s or something. Basically, what all it says is that we're trying to mitigate risk and maximize return, right? So in a typical portfolio here, you are going to have about 30% international, right? Let's talk about domestic versus international. Domestic stocks right now are at all-time high. It's understandable if you're a little bit scared of it. DeepSeek, the latest AI, if anything, put a little scare in that. Definitely threw a jab punch there. But I just want to go over what are the alternatives, okay? The alternatives are developed international, which is Europe, which is basically turned into a tourist destination. They really have not produced much of anything except for amazing vacations for a little while now, right? And then the second one is China, the emerging markets of China, right? And they're tripping over their communist feet right now, right? So even though America is still at the highest, I would definitely still bet more on America, right? We need that. We do need some diversification in there, right? But that's one thing that we're working on. And the second thing is that understanding, hey, if interest rates are high, that means my borrowing capacity is lower because I've got to pay 7% interest. And by the way, when we borrow from our investments or our home equity line of credit, I want to be clear, you still have to pay the interest, right? And if you're borrowing $250,000, $500,000, like that interest rate will get up there. So you really need investments that are going to produce income so that you could at least pay that, right? But what's beautiful in here is that, okay, your borrowing is higher. Guess who else is borrowing is higher? Everybody else is. So I know you'll have somebody come in and talk about hard money lending the other day, but that's one area where we are seeing some really cool opportunities right there. So let's say that we can borrow at 7% and go get 17% rate of return or whatever. We get an arbitrage of 10% right there. So when we're looking at a land right now where the opportunities look dimmer and dimmer and dimmer, there still are some opportunities on that lending side there.
I love it. Alan Franks, thank you so much for sharing with us today. We could probably talk we do another episode. We may bring you back in 6 months or so and revisit all this. You've got your book, Empowered Money. But if any of our listeners want to reach out to you and find out more about what you're about, what would be the best way for them to do that?
Thanks so much for asking. The best way to do it is our website is empowered-money.com, empowered-money.com. And on there, what we're going to be doing is putting our clips of the news clips that I've been on. We are also relaunching our own podcast. We're going to have news articles on there. But most importantly, we are going to have a button where you can do a 10-minute financial plan, where you input your information, you can see what your trajectory is. I highly recommend you take advantage of that 10-minute financial plan. I do want to let you know if you do that, we will reach out to you, right? Just full disclosure there. But on there, we are also going to have a button to set up an initial call with me on there. And those initial calls, I tell you, they're fun. They're complimentary. All we're going to be doing is strategizing the entire time. I'm an open book. If there's a way to make you money, I'm going to tell you because I'd rather you go implement it on your own than not implement it at all. So we can have a free consultation right there and really get some good ideas. And then what you're going to realize is that, hey, listen, there's a lot more to financial planning than meets the eye. We probably need to hire somebody to help us tie everything together, right? But anyways, you can go to empowered-money.com, do that free 10-minute plan right there, set up an initial consultation. And if nothing else, I promise you we're going to have some fun.
That sounds great. Well, Alan Franks, thank you so much for the listeners. This was recorded on February the 3rd, 2025. So we'll look at your Nostradamus powers and see if the advice you gave us worked out well. We look forward to having you back later in the year. If you're not on in September, October of this year, everyone will know what happened. Thanks, Alan. Really appreciate your time. Thank you for educating on this. Really appreciate your approach and spending some time with us today. Thanks.
Hey, thanks so much, Neil and Glenn.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.